Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So I want you to imagine a country attempting to basically buy back its global tech supremacy for $2.3 trillion.
Right, which is just massive.
It's astronomical, and all of this is happening while its own central bank is actively trying to hit the brakes on the entire plan. So today, we are doing a deep dive into this brand new, absolute behemoth of an economic strategy out of Japan. It's known as the Takeichi Plan, named after Prime Minister Sonny Takeichi.
Yeah, and based on recent data, this isn't just your standard government stimulus. It's an incredibly aggressive 14-year blueprint.
14 years.
Right, and the stated goal here is to mobilize a staggering 370 trillion yen, which translates to roughly 2.3 trillion US dollars, and they want to hit this by March of 2041. So our mission in this deep dive is to explain exactly how this plan aims to rewire the Japanese economy from the inside out, the specific mechanisms driving it, and the massive hidden risks that could literally bring the whole thing crashing down.
Exactly. And I think, for any American investor watching the current Trump administration's heavy focus on domestic manufacturing, securing American supply chains, this Japanese strategy is going to sound incredibly familiar to you.
Oh, absolutely. It's that same core idea.
Right. We are seeing this global theme of economic nationalism, and Japan is making a massive play to bring their own strategic industries back home. But according to the research we've looked at, this isn't just, the government handing out checks. It's a fundamental rewiring of how their corporate sector operates.
Yeah, that's the key difference.
Because $2.3 trillion is just an astronomical figure. We really need to look at where that capital is actually coming from.
Well, to put that 2.3 trillion in perspective, it represents a massive percentage of Japan's annual GDP. But the critical distinction that you as an investor must understand is that the Japanese government isn't just writing a check from the treasury to go build factories.
Right. It's not just a blank check.
Exactly. According to recent analysis, this is designed entirely as a public-private partnership. So the government intends to use this calculated mix of tax breaks, subsidies, guaranteed policy loans, and regulatory nudges to basically induce private companies to spend their own massive cash reserves.
Okay, let's unpack this for a second, because it sounds a lot like a corporate 401k matching program.
That's a great way to think about it.
Right, like a government initiative that says, hey, if you spend $1 upgrading your factory, we'll chip in 50 cents. But based on the data, how do they ensure companies actually open their wallets? Because, Japanese corporations have famously hoarded mountains of cash for, over 30 years?
Oh, easily over 30 years.
Yeah, despite numerous government attempts to get them to spend it. Why would a new round of tax breaks suddenly override a generation of, deeply ingrained corporate behavior? They've been practically allergic to domestic investment.
And that historical context you're bringing up is exactly why the Takeichi administration is changing tactics here. For decades, Japanese corporate culture was just scarred by this deflationary mindset.
Right, the lost decades.
Right. When a CEO expects their products to sell for less next year than they do today, the logical business move is to just freeze.
Just hold on to your cash.
Exactly. You don't build a new facility, you don't raise wages, you hoard cash and you wait. And that psychological freeze has been a generational drag on the country. But the structural shift happening right now is that the government is redefining the core problem itself.
So they're no longer treating it as a consumer demand problem.
Exactly. The data shows a complete departure from the past. For years, politicians thought Japan simply suffered from a lack of consumer demand, right? So they would mail out stimulus checks to citizens and hope for the best.
Which didn't really work.
No, it didn't. So the current administration is officially declaring that the real issue is a severe lack of strategic industrial investment. They are attempting to transition the country by force from a culture of saving to a culture of aggressive investing.
Wow.
This is fundamentally Japan's version of the U.S. Inflation Reduction Act. It's a massive, top-down, policy-driven push to force the private sector's hand.
By making the cost of not investing higher than the cost of upgrading.
You got it.
Okay, so if the government is finally figuring out how to pry open these corporate vaults through this, massive matching incentive program, the immediate question is, where is all that capital being directed? Because a plan of this scale must have very specific targets.
Oh, it does. Out of that 370 trillion yen target, a staggering 101.6 trillion yen is carved out specifically for artificial intelligence and semiconductors.
100 trillion just for chips and AI.
just for that. And the government estimates that semiconductor investments alone will create this economic ripple effect of 443 trillion yen by the year 2040.
What is huge?
It is. But it's not just tech. The plan also heavily targets defense, space exploration, and interestingly enough, shipbuilding.
Shipbuilding. Okay, here's where it gets really interesting to me. Let's focus on the semiconductor piece first,
Hmm.
because the strategy here feels a little counterintuitive. When American investors think of AI and chips, you immediately think of, like, NVIDIA designing the chips, right?
Or Taiwan Semiconductor manufacturing them.
Exactly. And Japan used to be the king of chips back in the 80s, but they lost that crown. Now, looking at this plan, instead of trying to build the next dominant chip brand to rival NVIDIA, it sounds like they want to own the picks and shovels of the AI gold rush.
Yes.
Like they are targeting the manufacturing equipment, the specialized chemicals, the testing gear. Is this a realistic way for them to actually win?
It's actually their best shot.
Yeah.
Global investors looking for Japan to suddenly start churning out the final cutting-edge AI processors, the ones that power massive data centers. They are fundamentally misunderstanding the play here.
Because that race is already too crowded.
Too crowded and incredibly capital-intensive. The data strongly supports Japan's alternative approach. They are aiming to completely dominate what we call the bottleneck technologies in the global supply chain.
Okay, I love this concept of bottleneck technologies. It's almost like a highly specialized toll booth,
That's a perfect analogy.
right? Like NVIDIA can design the ultimate sports car, and Taiwan can build the best car factory in the world, but Japan is trying to own the only facility that makes a specific type of asphalt required for the highway. You literally cannot drive the car without them.
Exactly. You have to pay the toll. In the highly complex world of semiconductor manufacturing, bottleneck technologies are components like ultra-pure chemical photoresists, extreme ultraviolet lithography equipment, high-end factory automation robots, and advanced packaging techniques.
Stuff most people have never even heard of.
Right, but the manufacturing tolerances for these AI chips are so microscopic that the materials used must be completely flawless. And Japanese companies already hold near monopolies in several of these incredibly niche, deeply complex chemical and mechanical areas.
So the Takichi plan is basically pouring absolute rocket fuel onto those specific sectors.
Yes, to ensure no country can build advanced tech without passing through a Japanese toll booth.
Wow. And, if they're aggressively funding this energy-intensive AI infrastructure, that actually kind of explains the sudden interest in shipbuilding. At first glance, throwing shipbuilding into a 21st century AI tech bill feels like a throwback to the 1950s.
Right, it seems out of place.
But modern shipbuilding isn't about, wooden hulls. It's intrinsically tied to liquefied natural gas carriers. They're subsidizing the massive ships required to transport the energy needed to power all these new semiconductor factories.
Exactly. And that connection between industrial policy and physical security is the defining theme of this entire 14-year blueprint. The investments in shipbuilding and space and defense, these aren't just for profit, they are about geopolitical survival.
Right, because Japan is operating in an incredibly tense neighborhood.
Very tense. You have China rapidly expanding its maritime footprint, North Korea continuing to test ballistic missiles, and there are constantly shifting dynamics regarding the defense alliance with the U.S.
So they are essentially building an economic fortress.
That's exactly what they're doing. By heavily subsidizing defense contractors and securing maritime shipping lanes, Japan is constructing what geopolitical analysts call an economic security investment cycle. They are no longer treating national security as a sunk cost.
They're treating it as a subsidized growth industry.
Exactly. Protecting the supply lines is just as important as manufacturing the bottleneck technologies themselves.
Which makes total sense. But that brings us to what looks like the fundamental flaw in the machinery here. Any government can draw up a magnificent 14-year blueprint, right? But an initiative requiring $2.3 trillion relies heavily on companies borrowing cheap capital.
Yes, it does.
If the government is stepping on the gas with all these subsidies, wouldn't that massive influx of cash trigger inflation, forcing their central bank to, step on the emergency brake?
And that is the biggest risk. That conflict between the government's ambitions and the central bank's mandate is the single biggest threat to the entire Takachi plan.
So how does this tug-of-war actually par out?
Well, the government absolutely requires low interest rates. If borrowing costs remain near zero, private companies can easily finance the construction of these new robotics labs and semiconductor facilities. Cheap capital is literally the oxygen for this 370 trillion yen initiative.
Right.
However, the Bank of Japan, the BOJ, just raised its policy rate to 1%.
Now, 1% might sound like, a rounding error to an American investor who's used to much higher rates right now. But in the context of the Japanese economy, that is a monumental shift.
It is the highest interest rate Japan has seen in 31 years. The era of free money is abruptly ending. Former BOJ Policy Board member Makoto Sakurai even recently went on record warning that the markets should brace for 2 more potential rate hikes by 2027.
Wow. 2 more.
Yeah, and the central bank is not raising rates just to punish the government. They are doing it out of necessity to fight off a historically weak yen, surging global energy prices, and painful domestic inflation.
So what does this all mean for the plan? Because we are looking at a brutal economic tightrope here. On one hand, if the BOJ caves to political pressure and keeps rates artificially low to help fund these factories, the Japanese yen gets absolutely crushed against the US dollar.
Which is terrible for everyday citizens.
Right. A weak yen makes importing basic necessities like food and the massive amounts of energy required to run these AI facilities punishingly expensive.
The resulting inflation would be economically devastating. But then you have to consider the alternative scenario. If the BOJ remains independent and continues raising rates to protect the currency, the cost of borrowing skyrockets.
And suddenly those corporate CEOs who have been hoarding cash for 30 years look at the government's factory matching program and say, yeah, the math no longer works.
Exactly. The loans become too expensive. If the private sector backs out, the 370 trillion yen plan collapses because the entire strategy relies on private companies footing a massive portion of the bill.
The vulnerability of this plan gets even deeper when you look at how they might cover those shortfalls. If borrowing becomes too expensive but the government still wants to force this industrial policy through, they have to find the capital somewhere, right? And the research mentioned the government has actually considered tapping into its $1.3 trillion foreign exchange reserves to fund this domestic spending.
Oh, and the mere suggestion of liquidating foreign exchange reserves for domestic subsidies has sent shockwaves through the global bond market. Those reserves are strictly designed to act as a national safety net. They exist so the central bank can intervene in the currency markets during a crisis. In fact, Japan already had to liquidate $73 billion of those exact reserves just this past May.
Just to defend the falling yen.
Just to defend the yen.
So when bond investors see a government treating its emergency currency defense fund like a checking account to pay for factory subsidies, they panic. It broadcasts that the government might be willing to sacrifice the long-term stability of the yen just to achieve its short-term industrial policy goals.
Yes.
And Japan already carries one of the heaviest sovereign debt loads in the developed world. Asking the global market who is going to pay for all this is a terrifying question.
It is. And that debt burden is precisely why everyday investors need to approach this market with surgical precision. You cannot treat Japan as a single, unified investment vehicle right now. The data shows that investors need to separate their strategies completely.
Right. So given this massive government push on one side and the central bank tug-of-war on the other, how should a beginner investor actually approach the Japanese market right now? It feels a lot like navigating a massive buffet.
Okay, I like that.
You want to load your plate up with the prime rib, which in this case is the highly subsidized robotics, defense, and semiconductor equipment stocks that are positioned to become the toll booths of the AI revolution.
Right.
But you absolutely must avoid the questionable seafood sitting under the heat lamp, which in this scenario represents Japanese government bonds, and the severe currency risks tied to the yen. Is that the right way to look at it?
The prime rib versus the questionable seafood is an excellent framework. I totally agree. The policy benefiting sector, so AI supply chain companies, power infrastructure, defense contractors, they have a historic government tailwind pushing them forward. They are prime targets for growth, but the JGBs and the yen are highly volatile liabilities.
Okay, so bifurcate the strategy.
Exactly. But to execute this strategy effectively, investors also need to factor in a very specific timeline.
Oh, okay. How does the timeline change the playbook?
Well, in the short term, looking at the next 1 to 3 months, the market will likely experience a massive hype rally. The sheer size of the $2.3 trillion headline is going to drive enormous speculative volume into those specific tech and defense equities.
Because the numbers are just too large for global institutional algorithms to ignore.
Precisely. But hype eventually collides with reality.
It always does.
So for the medium term, looking 6 to 18 months out, investors must demand operational proof. Don't just trust the political headlines. Political headlines do not generate dividends.
Right. You need to monitor major Japanese industrial titans, companies like Mitsubishi Heavy Industries or Tokyo Electron, to see if the subsidies are actually moving the needle.
Exactly. Are they actually announcing physical factory expansions? Are their quarterly profit margins expanding? Are they successfully capturing new overseas customers who rely on their bottleneck technologies?
We want to see the receipts. A government subsidy only works if it translates into actual labor productivity and technological dominance. If this massive mobilization just results in empty construction projects and, like, a temporary sugar high on the stock market, Japan will have simply financed the repeat of its past economic mistakes.
But this time at a much higher interest rate.
Exactly.
The ultimate stress test of the Takaichi plan is whether the capital injections foster genuine efficiency and wage growth. If the private sector successfully transitions from cash hoarding to strategic capital expenditure, the fundamental nature of the Japanese economy will transform.
Yeah. This has really been a masterclass in how a modern economy attempts to completely re-engineer its future. So to summarize for everyone listening, Japan is executing a historic pivot. They are trying to claw their way out of a multi-decade deflationary trap to become a dominant, policy-driven CapEx nation focused on AI and security.
Right.
They're betting their entire economic future on securing the critical supply chains of tomorrow. But they are performing this maneuver on a terrifyingly thin tightrope, forced to balance hyper-aggressive industrial spending against the gravity of crushing sovereign debt, a fragile currency, and a central bank that is actively raising the cost of money.
It really is the most complex macroeconomic balancing act in the world right now, and I will leave you with this final, broader implication to consider. We spent a lot of time analyzing Japan's strategy to own the toll booths of the tech world, right?
Right.
Well, if Japan successfully corners the market on these critical bottleneck technologies, the obscure ultra-pure materials, and the hyper-advanced manufacturing equipment required to build the next generation of artificial intelligence, how might that fundamentally shift the global balance of tech power between the US, Taiwan, and China over the next decade?
Oh, wow.
Right now, the narrative frames the tech war as a standoff between the United States, Taiwan, and China. But if Japan successfully secures the exclusive keys to the factories that build the future, they quietly transform into an indispensable, dominant superpower in the AI age.
It fundamentally changes the geopolitical map. Because if you own the only picks and shovels that work, every single gold miner in the world has to answer to you. It proves that you have to know exactly what kind of economic engine you are buying into and what forces are trying to hit the brakes before you allocate your capital. Don't forget to subscribe and hit that like button.